Joining us now from Exchange in Miami, we have Joe Nelesen with S&P Dow Jones Indices and Elise Terry with BlackRock. Well, Joe and Elise, it's great to have both of you with us. First, starting with you, Joe, what's the role of indices in constructing model portfolios?
Sure, I think indices are playing a really big role in allowing model portfolios to flourish. For me, it comes down to probably three main criteria. One is transparency, there's tailoring of the portfolio, so there's also tax differences. On the transparency front, you have indices that date back many decades, so there's a long history for a model portfolio builder to leverage up in terms of managing the portfolio risk and performance at the overall level. You have methodologies that are quite clear and transparent to the user, and holdings that they can see on a daily basis as well. On the tailoring front, there's more than 2,000 ETFs listed in the US that are indexed, right? That's not including active. And among those index funds, what might surprise you is that over 2/3 of those are deviating far from the broad market cap weight of an index like the S&P 500. So what that means is that model builders have a lot of tools available to really create finely tuned portfolios that are tailored to their clients' needs. And finally, there's the tax issue, right? We've done some research with SPIVA after tax last year, comparing how index-based products like ETFs compare to active funds in the same category. And we find that the tax differences in terms of the individual investor experience are quite substantial, even lending more fuel to the use of indices and models.
And Elise, how are model portfolios changing the landscape for advisors and their clients, and what's the role of ETFs here?
Great, thanks. So Joe just talked about how many choices there are for advisors. So model portfolios are really great for two things: scale and simplicity. When you think about when an advisor implements and starts utilizing portfolios, they can either build them themselves, they can follow another asset managers, or they can buy them straight off the shelf. No matter how you do it though, you have a very defined investment process. And that's great for the advisor and the client because they know exactly what to expect. Also, if you're buying them off the shelf from an asset manager, it's great for advisor and client because you're getting trade notices, you're getting the market commentaries, you're getting all of the surround sound that's helping you be very transparent. And the last and probably the best benefit is that if it is a portfolio of ETFs, you can expect to have lower costs, you can expect to have liquidity, and you can expect to have that tax efficiency that Joe just talked about.
And Joe, can SPIVA help shed light on whether there are some asset classes that are more suitable for constructed indexed ETFs?
Absolutely, and one of the great joys of my life is helping produce this paper recently here because the findings never cease to be interesting to me. I think there are certain asset classes, for example, like large cap equities. It generally is well understood at this point after 20 years of SPIVA that most managers underperform indices after some reasonable period of time. But some people might say in places like fixed income or emerging markets or small caps that there's still an opportunity to have an advantage. And the data suggests that it really isn't the case, right? Over a horizon like 15 years, for example, you'll find 90% or more on average of active managers underperforming indices. And that just goes to show that these kinds of markets are really becoming indicized, for lack of a better word, which I think is creating a lot of great opportunities for individuals and model builders alike.
And finally, Elise, should investors be worried about the growth of passive investing through models?
Great. I would say no. So I think that one of the myths around passive investing is that they can affect the markets in a negative way. And the truth of the matter is that ETFs own a very small portion of outstanding shares of all the individual companies out there. The other thing to keep in mind is that ETFs have always been synonymous with indexing or passive, and it's not just the case anymore, right? They come in all different size, shapes, and flavors, including active ETFs. The final thing I would say about models themselves is they're very actively managed. It is not a set it and forget it. They trade at least 4 to 6 times a year, and in some instances more than that. So I would focus on the benefits of the models that are made up of ETFs, which again, I go back to tax efficiency, liquidity, and low cost.
Well, Elise, Joe, thank you both very much for joining us today.
Thank you for having us.